Good evening, guys, and welcome to today's Technical Tuesday. Now, in this Technical Tuesday, I'm going to cover a out of the box subject. It's not necessarily going to be involved with technical analysis as such, but something I feel is much more important, and that's being patient. That's not jumping the gun when it's not needed, and just staying composed in the market is a very big lesson in itself, and sometimes these sort of lessons can pay the most in the sense you can be the best technical analysis trader in the sense, have those 1 pip stop loss trades with 200-300 pip take profit. You could, have the best institutional strategy or best strategy or, something along them lines where the technical analysis is on a very high level. But if your self-discipline and your mental psychology is not on that same wavelength, in the sense that you're jumping the gun too early, you're closing trades too early, you're not putting a stop loss because of how you're not giving your trade enough breathing room because you think it's going to go higher, etc. Those are all mental factors that you're taking into consideration that in a later date will pay a huge amount of negative dividends towards your actual trading career, and those are very bad habits that we do not want to get into. So I'm just going to basically be giving you an overview on how patience pays. So that's basically going to be the lesson of this Technical Tuesday, and I hope you find it insightful. So today we did witness a opportunity on GBP USD, and I had two limits present. Firstly was this limit called on the weekly outlook, and the second limit I believe was in and around that level there, which I will zoom in. But unfortunately, during the London and New York session, we didn't witness that significant pullback that I favoured in order to take that Pacific short. So I did not take the trade. And the reason because of this was simply due to how big a normal weekly range is on GBP USD. So just scaling back a couple weeks, I am using the FXN indicator for anyone that does want to portray this on their charts, and the settings I'm using is show day separate and days of the week on 1 hour chart, as we're on a 1 hour chart and it shows the separate days of the week. Also this option is ticked, show days of the week, and again all of my options are in silver, just to differentiate the white and the silver, but it's not standing out too much. And show weekly separated line, so this basically illustrates when a new week has started. So just visually I can see it, and it's a great indicator for just mapping out, understanding when's sort of best day to trade on a specific currency pair and when's the best day to sort of stand out. But nevertheless, I'm using this indicator to illustrate to you how powerful a normal week is on GBP USD, and just an opportunities that you can capitalize on. So for example, in this week on Monday, market open, we did have that sell off, but again, even Monday to a certain extent isn't the best day to trade. For example, if there's gaps on a prior day, as we see present here, what we would normally await for is an overall rebalance on that prior gap there, and again we're basically calling it a top and a bottom on GBP USD, in the sense that we're expecting a reversal trade to fill in that gap, and arguably give us a substantial return. So we don't really like to take tops and bottoms. Instead, we like to await for more favorable price action. And in saying that, upon having that push up, we then had that retracement to a sponsor candle, which then confirms our bullish entry. And upon reaching that sponsor candle and creating that new higher low, we then have that higher high, which in itself was arguably $300 pips, give or take a couple pips. But just that move in itself was 300 pips, not counting the whole weekly range, which totaled at a whole 430 pips, nearly equating to that 500 pip mark, just from 1 week of trading GBP USD. Again, looking at this structure here, again we saw that small sell-off, dropping around 146 pips, and then we had that bullish rise, again giving us a 250 pip return. So that in itself, 250 plus arguably 150, 2, 3, arguably 400 pips there. Yeah, that's right, to this sort of sell off from here to here. So arguably 150 pips, 350 plus 50, 400. So arguably a 400 pip return in that week. We see something similar here. So arguably 150 pip drop, 122 pip gain from there. So that's arguably looking at the 420 pip mark. Again, we see a bullish increase in this week by 260 pips. We see that contraction range, and we see that sell-off for another 200 pips. So again, that's 460 pips totaling. Again, from this week here, we see that bullish rise to 220 pips. But in saying that, we see that small sell-off from this. Whoops. From this high to this low, that's 100 pips. Arguably, you could have hedged your position here if there was an area of interest valid, or even gone long from this level here upon a reaccumulation of this sponsor candle here. So at that, and again, 100, 200, you're looking at the 428 pips. So notice how on average you're moving between that 400 and 500 pip mark, and this is what I mean when I say don't enter out of FOMO, because if you look at GBP USD right now in this week, we're currently just moving, I believe it's just under, you know, that 70, 80 pip mark. We haven't even reached that full on 80 pip mark, and I believe I'm being a bit generous in that sense from the actual mark. So if I mark it just from the high there to the low of that candle. So yeah, we're moving 73 pips in current profit, and now we know we can capitalize on, you know, 2, 3, 4, arguably 500 pip moves, depending upon retracements, depending upon areas of interest, reactions, and so on. So with this in mind, we can capitalize accordingly. And now I have two biases set. I am still expecting bearish bias all the way to this sort of discount pricing. So during the week, I can sort of counter trade my bias in the sense that we are in an overall bull trend, but I am looking for shorts. Upon waiting for my shorts, if the limit hits, it hits. If it doesn't hit, you know, you step back and you reevaluate. Okay, where can I go tomorrow? Notice how every single sort of trading day isn't a trading day. Notice how we had this sort of cluster in price over here. We had this contraction range over here. So it's a matter of understanding, okay, a move has took place. It's moved in our favored direction, which is always a good sign. We want to see price move into our favored direction, and then we react accordingly. Okay, now we've seen some bearish sentiment come into GBP USD. How can we capitalize this possibly tomorrow? So then we scale into a smaller time frame, for example the 15-minute time frame, and now we understand, okay, a lower low has been formed, a lower high, lower low, lower high, lower low, lower high. But what do we sort of see here? Relative equal highs here, prior engineered swing high here. Was it a clear mitigation of this candle? I don't think so. So now we can possibly look at this candle as an area of interest, right? So we can start monitoring that. We can maybe look for entries upon the mean threshold of that candle, and stops just go above it, and await for lower prices on GBP USD. So again, factoring you know, everything on a smaller time frame, understanding sponsor candles, understanding prior engineered highs and lows, and just getting a feel for overall market sentiment and the favored market direction, both on a bigger time frame and a smaller time frame, and understand, you know, are we counter trading the overall bias, in the sense the overall bias on GBP USD is bullish. If so, this is where we reduce our risk. Those of you who are funded by FTMO, what a rule I like to set with limits is a 0.15% risk. Now, if I put this in perspective with just one currency pair, and we look at our sort of risk to reward, you risk 0.15% with a 5.1 stop loss. I believe that is on a 100k account. It's a 2.5 pip. Sorry, a 2.5 lot size. So meaning that's £25 per point. Now we've got 189 pip take profit. So if you do 189 times 25, you know, that equates to £4,025 in profit, or dollars, if you're trading FTMO. So notice how that small lot size, that mandatory lot size, in regards to, you know, 100k FTMO, can pay a substantial amount of return, just risking minimal. 0.15% is very minimal. So in regards to limit, it makes trading stress-free, in the sense you're risking minimal in order to gain a very substantial amount. And again, you know, that's arguably, if you're on your personal account and you risk 1%, that's arguably 37%. The reason I would never recommend risking 1% on an FTMO is because it's equivalent to a 10%. Notice how FTMO give you a 10% drawdown limit. The reason is because the majority of the industry look at FTMO as a, you know, the cliche 1% risk. But in the longevity of things, if you're funded by 100k FTMO, really it's a 10k account. So you've got to treat it like a 10k account. If you had a 10k account, would you be risking 10% of your capital every position? No. You'd be risking 1%, maybe 2%. On favourable opportunities, 3%. But if it's a limit, in the sense that you're not occupied within that specific moment, maybe you've got a day job, etc., 0.15% on 100k FTMO is a very substantial risk sentiment to have, in the sense you can put on a decent lot and still gain a substantial amount. So with that being said, you know, if you get, let's say, a 1 to 10 on a 0.15% risk, you're looking at 1.5% R. Let's say you get a 0.20, a 1 to 20 risk to reward gain and take profit hit, you're looking at a 3% R. Now notice we don't just trade one currency pair, we trade 1, 2, 3, 4, 5, 6, 7. This is another factor to consider. This is just one currency pair. We're still monitoring Euro USD, we're still monitoring GBP JPY, we're still monitoring AUD USD, we're still monitoring USD JPY, which unfortunately did get stopped out by the spike. So if you did have a limit present, you know, we are -1R. But in saying that, it looks like we did form relative equal highs here. We have mitigated with this candle here. So upon a pullback, we could actually be looking for re-entries that could take us a lot lower. But this is a sort of a beautiful example, in the sense that if you had a limit present and you risk 0.15%, that's not even going to do a speck of damage in both circumstances on your FTMO. It's not going to put you in drawdown, and it's not going to affect your capital psychologically in any way, in the sense that when people go 2 to 3% drawdown from an FTMO perspective, psychologically it hits them. And the reason is because a 2 to 3% loss from an FTMO perspective is really a 20 to 30% loss from the actual account size. Right, the account size given is arguably 100k, but with the 10k loss limit, as soon as you hit that, the account's gone. So why do you take the account for granted when, you know, you're ideally blessed with the capital for such a small amount of investment? You know, I believe in the UK it's £500. You do the test. Obviously, if you pass the test, you're funded with the capital. So you ideally paid £500 for a 10k account. So treat it like a 10k account. You know, put risk on appropriately, and, you know, with our accurate risk to rewards, we can gain a substantial amount. So now you put in perspective a, you know, let's say 1 to 20 RR as sort of these sort of average between 1 to 20, 1 to 39, there 1 to 15, and notice there are multiple positions as well. And you have that 0.15% risk in mind, and let's say 2 to 3 currency pairs work well within the whole week, as we monitor in 1, 2, 3, 4, 5, 6, 7, 8. So we're monitoring 8 different currency pairs. Let's say 50% of them go right. So then you do 3% times 4, 4, 8, 12. That's 12%. Now let's say 2 get stopped out. Again, you're risking 0.15%. So all in all, that's 0.30% minus. So you're looking at a 11.7% return, and on an FTMO account that is arguably 11k, and then they take the 30% profit split. You're looking at that sort of 9.5, 10k sort of mark there. But in saying that, you can just see that's only 1 week's worth of trading minimal risk. And then when you get a bit more confident with the strategy and you start utilizing your own sort of trades, understanding how to refine entries, etc., and you take the trades accordingly, you can see how you can risk that additional bit more. So for example, instead of risking 0.15%, you can bump it up to that 0.25%, right? And the trades that have a lot of confidence and you're able to monitor, you can even shift it to that 0.5%. Now you scale ideally a 0.5% on a 1 to 20, you're looking ideally at a 10% gain just in that one trade. So it's all about refining, all about understanding, risk sentiment as a whole, and how we can capitalize on each opportunity stress-free. Because at the end of the day, this is the goal. Trading shouldn't be a stressful career. It should be, you put a trade on. If it does well, beautiful. If if it doesn't go in your bias, reflect upon that. Create a journal. Why didn't it go in my bias? How can I capitalize on better opportunities next time? And more, furthermore, what is the market looking to do next? Has it took out a prior engineered high? Has it broken market structure from that? Does that mean that that engineered high was ideally a raid in order to see more bearish momentum on that specific currency pair? Having a journal is a key thing in self-progression within the trading industry, and that's something I'm going to introduce later in this week. It's an app called Notion. It's a very good app for journaling, something I use arguably 24/7. I journal literally my London session, my New York, my overall daily trades, understanding why things went well, why things didn't go well, how I can capitalize on it next time, and I will illustrate some templates that we can all use together in order to have that more accurate refinement towards our trading journey, etc. But that was Technical Tuesdays, a little bit on the FTMO side, to say the least, but you can still apply this same methodology towards your personal accounts using the correct risk sentiment, and utilizing the strategy of high risk to rewards and arguably low stop losses. But the low stop losses are only present because the accuracy is there, and as you can see, we do get the corrective biases, but our limits just missed by the pip or two. But in saying that, we're always looking for refinements. But it's good in a way that the limits have missed to a certain extent, and the reason I say that is because we were in this bullish structure, making higher highs, higher lows. Yes, it would have been good if we got tagged in the limit and then saw this sell-off. But what the market's done right now is showing its hand. It's saying, okay, there is bearish sentiment towards price, and we can ideally focus on shorts tomorrow, and that goes for all currency pairs. We should be evaluating it upon heading into Asia, when the markets are sort of moving sideways. As during the Asian session, we shouldn't really move between above 30 pips. So any GBP euro base pairs shouldn't really be taken during Asia, as it just doesn't make any sense. But waking up for tomorrow's London and being active during tomorrow's New York, we can see some favorable opportunities for possible shorts. But yeah, that was Technical Tuesday, just explaining risk as an overall picture, and I hope you sort of took something from this, as in we don't have to take an opportunity every day. Whenever the opportunity is present, we have the limit present. If it hits our limit, perfectly fine. If it doesn't, then we react accordingly the next day. So yeah, that's Technical Tuesdays. I hope you enjoyed the video, and more importantly, I hope you have a good night. Thank you very much, and I'll speak to you tomorrow in the midweek review. Do it.